I'm StJohn Gardner, Chief Investment Officer at Sandaire. After years of markets favouring growth companies, is it time for a reversal to fundamental value? Over the last 10 years, and particularly so since the beginning of 2020, companies categorised as growth-type businesses have been outperforming their value counterparts to a point where the differential has rarely been so great. Growth companies are those defined as generating significant positive cash flows or earnings, which increase at significantly faster rates than the overall economy and tend to have a profitable investment opportunities for redeployment of their own earnings. The likes of Amazon, Apple, Netflix, and Facebook all fit into this category. A value company, on the other hand, is one whose share price trades at a lower price relative to its fundamentals, such as dividends, earnings, or sales, than the market appreciates, and is thus at an attractive valuation. Often these are mature companies with stable businesses, paying away their earnings as dividends, as they have few redeployment opportunities themselves, but could be seen as steady eddies. Many financials, banks, energy companies, including oil companies, and basic materials firms fall into this category, as well as firms like AT&T, Hewlett-Packard, and General Motors. Whilst unusual in the context of previous market sell-offs, when a shift back to fundamental value seems a defensive approach to keeping one's capital invested, the recent increased gulf in the outperformance of growth over value seems justified in light of the lockdown conditions brought about by the coronavirus. In relative terms, healthcare firms have performed well given the heightened medical emphasis, whilst IT, communications, and tech firms have also been strong performers given their business models require little or no face-to-face interaction. Simultaneously, firms carrying a lot of debt, common amongst value stocks, have been punished by the markets as the drying up of revenues for a couple of months of lockdown impacts their ability to service such debt. It seems reasonable, therefore, that those firms with strong balance sheets, common amongst growth stocks, are more likely to survive into an environment where the failure of indebted firms leads to reduced competition. Given the extent to which growth and value stock prices have responded to the pandemic, it seems reasonable to expect some unwinding of this phenomenon as we emerge from the lockdowns, and has led to our neutralising our former growth bias in clients' portfolios. Nevertheless, some of the sectorial effects of the virus will take many years to reverse, if they ever do entirely.